In today's episode, we're going to talk about tax loss and tax gain harvesting, the Roth and its 5-year rule, and then federal and state tax withholdings when you're making a withdrawal from your account. All great questions that we received into the client mailbag, so stick around as our discussions can help your financial picture.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Retirement Show, all about your life, your money, and today, your questions. I know it's a week early. I'll talk about that in a little bit here, but that's what we've got on track for today, talking about your questions that you've sent in. So thanks for sending in those questions. My name's Scott Searins. My goal is to help you thrive in life, wealth, and retirement. And we're right there at the end of the year, so wanted to just tell everybody happy holidays and thanks for listening in. Happy holidays. I hope that you're enjoying the holiday season. I hope that you get to spend some time however you wish to spend it this holiday season, whether it's recharging your batteries, time with family, but hopefully that you get to spend it and enjoy it. Also, thanks for listening in. It's been a great year this year, just a great year of helping out clients with their retirement stories. I mean, for some clients, that meant celebrating their retirements this year. For others, it meant trips with their grandkids, trips that they had, wanted to take, planned to take, were hoping to take, and got to take. For some people, that was moving to different locations. For some people, it was retiring early. All different stories. And so glad that we got to help people achieve, I'll say, some more pages in their retirement storybook. So that was great. Also a great year of helping out new clients, new people that have reached out to us with their retirement stories, helping them feel comfortable about setting their retirement dates for next year. For some, potentially starting a side business. Others, taking a trip overseas, whatever it might be. I mean, it's just so different for everyone because we all have our own unique stories and situations that we want to live out. And that's what it's all about to me, is helping people maximize their retirement story. So whether you're working with us, a client of ours, a new client of ours, or just listening to the show, I hope that I've gotten to help you in regards to your retirement story, and look forward to next year of doing the same. So also just wanted to quickly talk about what I'm going to do is just take a little bit of a holiday break here. So for the next couple of weeks, there won't be a podcast episode, and then we're going to start strong right back after that, but just going to take some time, recharge the batteries, enjoy some time with my wife, enjoy some time with our family, and just enjoy taking a little time off and just trying to recharge. And very, very excited about 2024 and what 2024 has to bring for all of us. I'm really excited about having an increased focus in 2024 on our YouTube channel. So if you haven't checked that out yet, go check that out on YouTube. It's Searins Financial Group. That's Sierens. Our YouTube channel continues to grow as we just want to continue to bring more value to you and to your retirement planning purposes. So Sierens. Check out our YouTube channel. Subscribe. That way you get notified. We're coming out with new videos on that channel each and every week. So, all right, here we go. Today's episode then, since today will be the last episode of the month, as we're going to take a little bit of a holiday break. Today is going to be answering those mailbag questions. And we've got 3 really good questions that have been sent in. One that you could potentially still use here by the end of the year, all about tax loss and tax gain harvesting. Then we've got a question in regards to Roth 401K rules. And then question in regards to withholding. Now, it's a question in regards to withholding money as you make withdrawals from a specific kind of an account here. And so listen in because you might have this question on your mind as well. So let's get started. Let me flip over the paper here. Here we go. Let's get started. Our first question coming in from Miyuki. Now, Miyuki says, can you explain more about tax harvesting? I've sold 2 individual stocks last month, thinking that they are not performing as well as I thought they would. Both of them are a loss. Now, I heard something like tax harvesting, but I don't know how I can take advantage of my loss. Well, Miyuki, thanks for sending in this question because it's actually a really good year-end planning question, year-end planning tool. And let's see, this is coming out probably around somewhere in the 21st, 22nd of the month. And so you still have time before the end of the year, December 31st, to potentially do some tax loss harvesting in your accounts. Now, this is something that we're kind of looking at throughout the year for all of our clients. But if you're managing on your own, this might be something that you want to take a look at. Now, let me just help break this down. There's two parts when you hear about tax harvesting. There's tax loss harvesting and tax gain harvesting. Now, I know a lot of people in the past were really pushing and talking about tax loss harvesting, and if you weren't doing it, you felt like you were missing out on something, and how do I do this? And I mean, once I go through it, you realize tax loss harvesting is helpful, but it's also kind of like going against the rules of investing for the long term. So you'll see that as I go through the rules, but I think more importantly is also tax gain harvesting. And you want to have a good combination of both of these. And let me explain it here and hopefully I can help you in regards to what you're thinking about. But anybody else listening as well, if you have a brokerage account, an individual account, a joint account, a trust account, basically any sort of non-retirement account, this applies to you. Now, just so everybody knows, the accounts that it does not apply to would be like your IRA, 401K, Roth IRA. The reason it doesn't apply to those accounts is because you can buy and sell and trade in those accounts all day long, but those losses and gains are never pushed off to you because they're in the IRA or Roth IRA or the 401K or the 403B, and all of the gains and losses in those accounts are deferred. Or in the Roth standpoint, they're all tax-free, so you don't have to worry. So this is in regards to if you've maybe like opened up a brokerage account or an individual account, joint or trust, like I had mentioned before. And as Miyuki mentioned in her question here, she said, I sold a couple stocks and there were losses. So I mentioned, right, we're going to talk about tax loss harvesting. That's first, but then I want to go through tax gain harvesting because you might want to know and understand that because you might want to use some of your losses to offset some of those gains. So let's go through both. Make sure you fully understand it here. All right, tax loss harvesting. Let's start there. It's almost like you're trying to get a tax write-off. So if you have losses, you could potentially have a tax write-off, and I'll explain that here. So tax loss harvesting in the types of accounts that I mentioned. Now, this could be based on a stock or a fund. It really doesn't matter. So you had mentioned you sold a couple stocks, but if somebody's going, well, wait a second, I have a mutual fund or an exchange-traded fund, it applies to them too. It doesn't matter. So I know you said stocks, but I'm just going to use a fund just to kind of change it up. But I'll just take what you have and put it into this formula that I'm going to give you. So for example, let's say you own VOO, which is the Vanguard S&P 500 exchange traded fund. Let's say you own that fund. Again, if you have a stock, substitute stock in its place. If it's Apple or Facebook or whatever it is, substitute it in its place. Doesn't matter. You'll see how it all works in the end here. Now, and all of this is, I'll call it just hypothetical numbers to get you the formula for your situation. So it's all hypothetical numbers here. But let's just say you had VOO. You bought 10 shares at $1,000 per share. So again, fill in your numbers. 10 shares, $1,000 per share. Well, your value would be $10,000. 10 times 1,000. That's your value. They also call that, so in these brokerage accounts, individual accounts, joint accounts, they also call that your basis. It's just the financial term for it, your basis. It's basically the initial amount, the base amount that you put in. That's your basis. Okay, so now we understand the basis. Now, how many ever months go by, or days? I guess days could happen too, right? Or years. Time goes by. You take a look at the account value, and the price per share. And you look at it and you're like, wait a second, I bought it $1,000 per share. And you look at it, you open it up and you're like, oh man, it's down to $600 per share. So you go, wait a second, I've got 10 shares times $600 per share. I'm at $6,000. My account is down $4,000. Do you have a loss? Right now, you actually don't have loss. I know a lot of people look at this and they're like, I'm losing money. You never lose until you sell. Okay, I just want to make sure that we're all on the same page there. You never lose until you sell. Once you sell, well, technically you may have lost money unless you're going to reinvest. We'll talk about that in a second here too. But you don't lose until you sell. But let's go back to what Miyuki said. Miyuki sold. Miyuki sold. So now there actually is a loss. You have a loss. So let's use my example here. You sell all 10 shares at that $600 per share. Well, that's a value of $6,000. Now that you've sold, they actually say that you do have a loss. It's called a recognized gain or loss. In this case, it's a recognized loss. And guess what? You get to write off your losses on your taxes. That is totally true. So you're probably thinking in your mind now, well, wait a second, this is really good. And there's good and bad to it, right? And we'll talk about that. But you actually do get the write-off on your taxes. So if you sold all those shares, in my example, there's a $4,000 loss, you get to report this on your taxes. However, because I know what you're thinking, wait a second, the market goes way down. Why wouldn't everybody just sell, take this ginormous loss on their taxes, and then just reinvest? Well, the IRS is really thinking ahead of you on this one. You can't necessarily do that. And there's two rules that you want to be really cognizant of here. First off, on your taxes, the max loss that you're able to report every year is $3,000. So if you have a $50,000 loss, a $100,000 loss, $1 million loss, guess what? You get to only report $3,000. So that's part one. The second part that I had mentioned is, well, then why wouldn't everybody just do this and then reinvest right away? Just put it right back in the same thing. Well, they also have what's called the wash sale rule. So in my example, if you sold the VOO, but you're like, I'm just going to buy it the next day, guess what? Now you don't get to take advantage of those losses. The wash sale rule says investors who sell a security at a loss cannot claim it if they have purchased the same or similar security within 30 days of the sale. That's 30 days before, 30 days after. So in my scenario here, if the next day I bought VOO again, guess what? That $4,000 loss, which becomes a $3,000 write-off on the taxes, it's no more. So I've taken a loss, plus I wouldn't get to write it off on the taxes. But if I wait 31 days and then reinvest in VOO, well, no, yeah, actually I can write off those losses on the taxes. And it's a write-off. When I say write-off, it's just a deduction on your taxes. So, for instance, if you've made $100,000 this year, and in my example here, there's the $4,000 loss, you only get to write off $3,000 each and every year. That's the max losses that you can write off. Well, then, instead of $100,000 income, guess what? 100,000 minus the 3,000 losses. Now I'm only getting taxed on $97,000. That's how you can take advantage of your losses. However, this kind of goes against long-term investing, and you might be thinking that, right? Wait, Scott preaches long-term investing on his podcast. He talks about the benefits of staying invested for the long term. And you're right. And that's why I kind of, when people are out there and they're like, oh, did you do your tax loss harvesting this year? Did you harvest those losses? Well, aren't they kind of telling you like they put you in the wrong investments? And there are times where we do harvest losses, for clients, but it's part of also harvesting gains, which I'm going to talk to you about next. Or it is harvesting losses, but then waiting for that wash sale rule to be over, the 30 days to be over, and getting invested back again in the market for the long term. So yes, we want to utilize this rule, but if you're thinking that you're just going to constantly sell for losses so you can have these write-offs on your taxes, well, guess what? then you're just not making any money. So, hey, sometimes we make bad investments. We just got to write off those losses and move forward. Sometimes there's strategy, so you want to be putting strategy behind it. And then sometimes we're going to offset the gains. But if you're just constantly selling to take losses, you've probably just made some really bad investments, and you're making some really bad decisions because you're just not having any gains at all. So that's not helping you one bit. Now, as I had mentioned, I would recommend that, okay, if you have some losses, are there some gains that you want to offset? Now, let's add to the example here. Let's say you also bought VXUS. That's the Vanguard International Fund. And again, the numbers I'm talking about today don't actually represent the share prices. It's just for our example purposes today. So let's just say at the same time that you bought the VOO, you bought VXUS, and you bought 10 shares again, and they were again at $1,000 per share. So your value or your base of money that you put in, the basis is $10,000. Now, same time period later, you look at those shares and you're like, wait a second, the price per share went up to $1,300 a share. Again, I'm not saying VXUS went up or down. I'm just using numbers for an example today. That's a nice gain, right? You do the multiplication, you're like, wait a second, now the value of my account is $13,000. And if you've heard me talk before on the podcast, you realize, wait a second, when we have a gain and it's in a non-retirement account, guess what? We have to pay tax on the gain. If we sell, we're going to have to pay tax on the gain. Our base is $10,000 and we now have $13,000. We're going to have to pay tax on that gain. So, and depending on how long you held it, you might have short-term gains at ordinary income tax, long-term gains at capital gains rate. So what could we do here? One, we could do nothing, because if you don't sell, you're not recognizing anything. You don't have to claim any gains on your taxes. But then you just hold it longer and longer and longer, and guess what? All of a sudden, this becomes really valuable in the future. And when you do need the money, you're like, oh man, now I got to pay tax on these gains. So the other thing you could do is you could harvest gains, meaning you could get your basis increased, use some of your losses to increase the base on your gains here. So for instance, let's just say you sell that VXUS. Well, you're going to have $3,000 of gains on your tax return. However, you just captured some losses over there when you sold your VOO. You captured $4,000 of losses. So we do some math here. Guess what? The $4,000 of losses offsets $3,000 of gains, and you still have a balance of $1,000 losses. And, right, the wash sale rule only talks about losses. So on this standpoint, you can buy that VXUS right back at that $13,000 price tag. And guess what? You just captured those gains. You just increased your base. Your base was $10,000. You sold at $13,000. You bought right back at $13,000. And your base is now $13,000 versus $10,000. But when you sold for those $3,000 of gains, you also had the losses that offset them. You don't have to pay any taxes on those gains. You use your losses to offset the gains, and you still have that $1,000 loss to put on your tax documents. So that's tax loss harvesting. That's tax gain harvesting. I would focus on, okay, if I've got some losses, and yes, you're selling them, you're like, I got to be done with this position. It was a bad one. It didn't work out for your situation. Are there gains that you can offset it with and increase your basis in your overall portfolio? So got a little bit into the weeds there, but hopefully now you can use that, put your information into it, and understand how you can use that from a tax standpoint. And this is something that we do for all of our clients because we have the systems and tools to do so. I'm sure as I'm going through that, and maybe by the end, or if you listen to my 15-minute spiel there, you're like, wow, that's a lot of work because I've got a lot of positions in my portfolio. It is a lot of work. It is a lot of work to do. And that's why people hire us. People hire investment managers, because then we're doing that work for our clients to make sure that the losses and the gains are all properly captured. But if you do things on your own, hopefully that kind of also leads you down the right path. If you're not doing things on your own, but if you're like listening to that going, I have no idea if our person's capturing losses or gains. Well, hopefully they are. And if not, then maybe it's time to take a look around, because you want to make sure that you're capturing all of the tax efficiencies that you can in regards to your situation, because helping to minimize your taxes helps keep more in your pockets. All right, let's go on to questions 2 and 3, probably a little bit shorter on these questions, but some great questions to help everybody out, especially if you got a Roth 401K or a Roth IRA. You want to listen into this question here. This question from Lauren, it says, I was just laid off due to lack of work. I am past full retirement age. Roth side of 401K, started that in 2019, hits 5 years, the first of 2024. Can I withdraw Roth 401K side without tax consequences after 2023? Thank you. Well, thanks for sending in the question. So let's just kind of go through the question here of what they sent in and kind of break out some different parts and get to the answer to the question as well. One thing that they put in here was, I'm past full retirement age. Well, just in case anybody's listening and they're trying to tie that to the question, just so you know, full retirement age, or FRA, is all about Social Security. So really does not impact taking money out of your account. Social Security age doesn't impact taking money out of your 401k or your IRA. But from my standpoint, what it does mean here, it does mean that the listener is over age 59 and a half. Because if you're under age 59 and a half, you might have some early withdrawal penalties. But just in case you heard that and you're trying to tie all of that together, there is no connections between Social Security ages and taking money out of your accounts, just that age 59 and a half. Now, Roth 401k talked about hits 5 years. Where does this 5 year, why are we talking about 5 years here? Well, the Roth 401k, Roth IRA, there's what's called the 5-year rule. Let me explain this 5-year rule. The 5-year rule says that you cannot withdraw your earnings until after 5 years from your first contribution. Now, let me be really clear about something. You can always withdraw your contributions without penalty. But the 5-year rule says you can't withdraw your earnings being gains, earnings being interest, earnings being the amount that the account went up. You can't withdraw that until after the 5-year mark. And a question that I get all the time is, well, if I put in $1,000 this year, and this is my first year, then I get that, the 5-year rule starts. But what if I put in $1,000 next year? Then is that another 5-year rule? And then if I put in $1,000 a year after that, is that another 5-year rule? It's one 5-year rule, and it starts at the beginning, the first contribution that you ever make. And if you're opening up multiple Roth IRAs, it's from the contribution to the first Roth IRA. Now, the 5-year rule, there's the 5-year rule for the 401ks, Roth 401ks, and the 5-year rule for the Roth IRAs. Those actually would be two separate 5-year rules. But if you have multiple Roth IRAs, guess what? They all go by the first contribution to your first Roth IRA. Okay, so that's the 5-year rule. It's not my rule. It's not because we host clients' money at Fidelity or Schwab or Vanguard or anything like that. It has nothing to do with where you're putting your money or the mutual fund or exchange-traded fund or whatever you're putting your money in. It's an IRS rule. That's whose rule that is. That's the 5-year rule. So the listener here says, hey, we've got, we started in 2019, so if we got 2019, 20, 21, 22, 23 would be the end of the 5-year rule. Guess what? Starting the 1st of 2024, they can now take out both their base, the contributions that they made, plus the earnings from their Roth 401k, and they can do all of that tax-free. So based on the information that you've given me here, starting in 2024, it appears that, yes, you could take out from your Roth 401k without any sort of tax consequences. Now, if you really needed money here within the last couple weeks of 2023, right? You're like, I don't know if I can make it to 2024. I'm not sure. Well, guess what? Like I mentioned, you can take out your contributions without penalty. Again, and that's kind of the whole really interesting thing about the Roth here. Contributions, you put in, you can always take your contributions out. Why? Well, you paid tax on the money that you put in, so you've already paid tax on that money. You can take that money out. The gains is where you have to wait for that 5-year rule from your first contribution, not subsequent contributions, the first contribution. And the Roth grows tax-free, withdraws tax-free. So the only thing really, once you get past the 5-year rule, and I know this person passed full retirement age, they are over 59 and a half, but in case anybody else is listening, if you are pre-59 and a half, you would have a 10% early withdrawal penalty if you're taking out those earnings. So hopefully that helped out. Appreciate you sending in the question, which leads to our third and last question of the day, which is pretty similar here, but the person's now kind of taking it one step further. This question says, and this is from, I think they sent in their username from probably like a YouTube or something like that. It was PRANDN. The question here is, hey, the 401k plan has pre-tax and post-tax, being Roth. Money that I take out of the post-tax, the Roth 401k, is withholding required on distributions that are the post-tax, the Roth 401k money. All right, let's just break this down really quick. I'm sure as listeners you've heard it over and over, but we just want to make sure we're all on the same page. Pre-tax, traditional 401k. You get a tax deduction when you make the contribution. You pay tax when you take money out. Roth 401k, you pay tax when you contributed money to the Roth 401k, but guess what? It grows tax-free, and all of the withdrawals on what you put in and the growth is all tax-free when you take it out. So if you're taking money out of your Roth 401k, your Roth IRA, there are no federal taxes. No federal taxes. So if there's no federal taxes, do you need to withhold money? You certainly don't, but it all depends on your 401k company. Now, hopefully with your 401k company, you can opt out of withholding taxes. Now, there are some 401k companies that just have like standard rules, standard things that they won't let you get by. And if they make you withhold taxes, that's really weird. That's really not, I'll call it almost unfair because it's Roth money. You shouldn't have to withhold taxes. It's tax-free. It should come to you tax-free. So if they have kind of like, tough rules, standard rules, and I've just found just working with clients to help them roll over money from their 401ks to their IRAs and their Roth IRAs, that sometimes these 401k companies just make it really difficult to do distributions and to do withdrawals. So something that you might want to think about here is taking control of your money, meaning rolling it over to an IRA, rolling it over to a Roth IRA, because then when it's, let's say your Roth 401k, you get it to the Roth IRA, now you get to be in control. You get to be in control of the funds that get selected for your account. Plus, you get to be in control of the withholding. So, for instance, we have clients that take money out of the Roth IRA. We take the federal withholdings, the state withholdings, we put them at 0% because there's no taxes on those accounts. And then their IRAs, guess what? They get to choose how much percentage is withheld from those withdrawals. So, took it a little step further. So, hopefully, we're helping other people as well with your question that you've asked. But from the Roth 401k, shouldn't have to withhold any federal taxes when you take that money out. That's tax-free money. Enjoy that tax-free money. You did a great job saving into that account. So, hey, hopefully all of the questions here, you're finding some value and benefit in the responses that we're providing. Got a little bit into the weeds on the first one there, but I thought it might be helpful for you to understand tax loss harvesting, tax gain harvesting. You hear a lot about it, and people talking about year-end planning, and it is definitely something to do. But if they're just focused on tax loss harvesting, they also should be looking at tax gain harvesting. We're looking at both. We want to make sure that our clients are capturing not only losses based on things that we can do from a strategic standpoint, but why not take the advantage of increasing our basis while we can do that, taking gains off the table that we would normally have to pay tax on later in life. So hopefully that helped you understand that, because heck, we want to take advantage of any tax opportunities that are out there to us. Plus the questions on the Roths, super helpful. More people now are saving into their Roth 401Ks, the Roth IRAs, and it's super helpful to know the rules around the Roth so you're not getting penalized for taking out any sort of earnings earlier than that 5-year rule. So hopefully you found a ton of value and benefit in today's podcast. If so, don't forget, subscribe on your favorite podcast player. Check us out on YouTube at Sirens Financial Group. And I look forward to chatting with you in the new year and having some great conversations to help you maximize your retirement story. Happy holidays, happy new year. Talk to you next year.
Insurance products are offered through the insurance business Sirens Financial Management, Inc. Sirens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sirens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sirens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sirens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sirens Financial Group, Inc.